Hello everyone, welcome to another QuantInsti webinar. Interestingly, we have got registrations from 70 plus countries in this webinar, and we've been doing this webinar since last 4 years. And what we've seen is the way we have grown across, different various aspects of algo trading, not just very focused onto a particular aspect, but very different. Trading instruments as well. So that is something very interesting that we have seen. Now, for today's webinar, I think most of you from what we have saw are coming from the trading background. Many of you are coming from programming background, and a lot of freshers and students have also shown interest in this topic. And it's very interesting the way artificial intelligence, machine learning, and automation is changing the way we are doing things these days. And the financial markets is also not very different from that, and it is also evolving with the help of technology. So I welcome you all again. And for today's webinar, we are going to have a very special guest, Sunil Guglani. So Sunil is someone who has experience of more than 20 years in the information technology industry, and 1.5 years back he moved his focus to algorithmic trading and technology side on the financial markets, so where he started exploring his career opportunities, and on his own he has learned a lot. And today, right now, currently he is working with NCDEX as assistant vice president. So it's quite a journey that he has, and the experience that he is going to share with us here today in this webinar. And it's amazing to have you here. Sunil, are you here with us? Welcome to the webinar.
Yeah, hi everyone. This is Sunil Guglani. So very good evening to all of you, and thanks for joining after your working hours. I can understand, and from the other countries, I can understand there may be some odd hours, but still you have joined us. You have showed the interest, so I am really thankful to all of you. So today we will be discussing algorithmic trading with commodities, and specifically agricultural commodities. And I'm working with NCDEX, that is National Commodity and Derivative Exchange. NCDEX is one among the top 4 trading exchanges in India, and it is the largest agri-commodity exchange. It was started to help farmers around in year 2003 to mitigate their risk using hedging and arbitrage. So we offer around 20 commodities where we can do the trading. There are 300 members and brokers are there with 487,000 clients. We also have a subsidiary which has around 500 approved warehouses. If we talk about commodity in various segments, we take care. The commodities can be divided into cereals and pulses, spices, fibers, guar complex, oil seeds, and sweeteners. And let's talk about what kind of strategies we can do in the commodity market. So there are different ways of doing the trading style. One is hedging and arbitrage and directional trading. These are the 3 ways of doing the trading in commodity market, which are very popular. Let's talk about hedging now. So hedging, most of you must be already knowing, but let me explain that it is the investment to mitigate the risk from the primary investment which we have already made. So some few people call it as a insurance also, insurance against the primary investment. So again, why we have to do is to mitigate the risk. And in NCDEX, people do it for the farmers. Farmers have their own underlying assets. To mitigate that risk, they hedge against, NCDEX commodities. So the very important thing here it is that the underlying assets between the two underlying assets of the hedging has to be highly correlated. Then only hedging is possible. Otherwise, it is not advisable. The next kind of trading style is arbitrage, which is very popular in commodities. There are two ways of doing that arbitrage, which in commodities. One is calendar spread, another is pair trading. In calendar spread is nothing but the spread between two future or option contracts of the same commodity. It is almost similar to, we can say, the hedging. The only difference is it is with the same underlying asset but two different calendar contracts. So in this way, we keep the hedge ratio as -1. So it makes itself is a stationary series. Because it is a stationary series, it is very easy to apply mean reverting strategies on that. We can say it is very low in risk and high in profit. And if you talk about pair trading strategy in arbitrage, it is again very similar to hedging. The difference between hedging and this is generally we do the hedging, the pair trading between two different instruments of the same family, because if they belong to same family, the correlation between the two instruments will be very high, or the commodity will be very high. So generally this also converts into stationary series. Because it is stationary series, we can easily apply the mean reverting trading styles. In this, again, in pair trading, we need to make sure that two commodities which we are choosing, they has to be highly correlated. And again, we need to check the co-integration also should be there between the two commodities. So for co-integration, generally we apply AD Fuller test. That is very much recommended before we start the pair trading between the two commodities. That was about NCDEX and commodity market. That what are the strategies we should use in commodity market. Let's talk about algorithmic trading stages now. So what are the various stages which are there in algorithmic trading stages? So there are multiple stages are there, and most of them are iterative in nature. Mean if we complete one stage and go to the another one, it is possible that we may have to go back to the previous stage. So first one is we have to identify the trading idea or trading concept. And once we identify the trading idea or trading concept, we need to filter out the scripts or instruments on which we need to apply that trading idea. And once we identify those scripts or the segments, then we need to see that whether that trading idea fits with those commodity or instruments or not. For that, we need to visualize the model. So that is kind of high level of verification of the trading idea which we are going to apply. Once we are fine with visualizing the model and we understand that it is going to work, then we can go for the backtesting. Backtesting is the detailed verification of the idea which we are planning to implement. After that, we need to move forward and we need to optimize the parameters or the model depending upon the backtesting results which we have got. Next stage would be the paper trading. Paper trading, we all know that it is actually doing the trading without any money. So this is again next level of verification. So once we are fine with paper trading, we can go live and we can put the real money into it. So let us start with the very first and very important trading stage, algo trading stage, that is trading concept. So in trading concept, there are various activities are there which we need to perform in this particular stage. First thing would be brainstorming of the idea. Mean there we might be having multiple ideas with us, but we don't know with which idea we need to continue. So we need to do the brainstorming. We have to come up with some idea. So once we are fine with that, once we do the brainstorming, we need to finalize or conclude one trading logic idea which we want to continue. After that, we need to identify how many trades we want to take during a period. Mean what will be the frequency of the trades, whether it will be intraday or daily or weekly, that we need to identify. And after that, we need to identify which segment we want to use for that trading idea. I mean, how much suitable it is for which particular segment, whether it's equity, commodity, forex, crypto, or something else. As per the frequency of trades, we need to define the backtesting period also. And after that, we need to go for automation tools or languages. So for brainstorming, let us look at this particular sheet. You will be able to see multiple figures into it. So this is actually nothing but the GDP, gross domestic production of annual and quarterly of India, of the various sectors across a period of time on different quarters and years. So I would like you to look into this data and see whether we can use this for any strategy or not. I will give you around 30 seconds. Just look into it. Then we'll move to the next slide. So as you see, it's not so easy to understand and these figures, and it's very difficult to make out whether we can make any trading strategy with this data or not. So what we have to do, I just converted that data into some visualized form. So as we see in the previous slide, this data is segregated into various sectors: agriculture, mining, manufacturing, electricity, construction, and so on. So I have just converted that table into some graphical representation in the line chart of each of the sector over a period of time. So now it looks little better. So now we can see that maybe if some particular series is range bound, then maybe, and we need to see whether it is related or correlated to price of that sector or not. Now again, I will take you to the next slide. Now this is very specific to one particular sector, that is agriculture. If we see that this is a GDP of agriculture of over a period of time or for various years and quarters. Now you will be able to make little more sense with this data. Now this is the fourth slide. This is again the visual representation of same data, but in the different way. So if you see that this is quarter 1, quarter 2, quarter 3, quarter 4, over around 9 years of period. Each quarter has we are showing for around 9 years. So I will give you around 20 more seconds to look into it and see what you can make out of this data. So if you look into the data, then it looks like the quarter 1 and quarter 4, are almost similar. The progress of the growth of quarter one and quarter four are almost similar, whereas quarter two it has the smallest growth. Quarter three has the most fastest growth. So what we can understand with that? So whenever the GDP is more or the production is more, what will happen? And whenever the GDP is lower, the production is less, what will happen? So maybe we can think of correlating with the price. When the production is less, maybe the price will go more. Whenever the production is more, the price may go down. So with this, we can correlate the GDP with the price of the commodity, and this is one way of doing it. There could be multiple factors behind it. So this is just one way of coming to some particular strategy just by given the data. So this is about how we can do the brainstorming. So before we go a little further, I would like to discuss some of the algo trading resources which we will be using across these stages. I'll go back to the previous slide. So please look into this slide carefully. So these are the various, I have divided the algo trading into various segments where we can, and there I have mentioned the various resources which has to be used or which can be used for algo trading. So first thing which is most important is strategies. In what kind of strategies are required or can be used in algo trading? So these are just the samples, not the comprehensive list, I would say. So strategies can be divided into mean reversion strategy, arbitrage, or momentum. In mean reversion, generally it has to be performed in the stationary series. Arbitrage, as we have just discussed before, that it can be pair trading or can be based on correlation, co-integration. Momentum can be based on moving averages, linear regression, logistic regression, or probability distribution. And a very important thing in algo trading is infrastructure. So in infrastructure, what kind of infrastructure is required? We need to connect with the broker through API. That is very important. There are two reasons to connect with the broker is. One is we need to have the historical data as well as the latest live data on which we can build our logic, and we can pass buy and sell signals. And another thing is order management. We need to pass buy and sell orders to the broker so that the orders can be executed. So connection with the broker is very important. Next very important thing is we have to host the algo somewhere. So there are two ways of doing that. We can do this through at in-premise, mean we need to have all the infrastructure at our own place. It will be hardware, network, software, everything. We need to arrange it at our own premise. Another way of doing is to host it in the cloud. Like there are various cloud vendors are available in the market, like Google, Azure, Oracle, AWS, and Alibaba, which are very popular. So you must be familiar with most of them. So these are the two very important things are there in the infrastructure. And next thing is, as we have just discussed, that while conceptualizing the data, conceptualizing the idea, we need to have some data visualization in place. So data visualization, the some of the graphs which we have just seen, I have used Excel and Tableau to make the graph out of them. So for brainstorming of the idea, we need to use the tools like Tableau, Power BI, or Matplotlib or something like that. And for or checking the buy and sell signals or applying the indicators, technical indicators, we can use something like TradingView. These kind of tools will be very helpful for us. And let's talk about what are the algo development tools are required. So if I would say in non-programming or semi-programming tools, MetaTrader, AmiBroker, and NinjaTrader are very popular. But if we talk about pure programming tools where we can do anything, then Python is the leading programming language among all of them. And if we talk about HFT programming, then yes, C++ is more important because of the speed of the and performance of the order execution. But otherwise, if it is non-HFT, Python is the leading programming tool. So in this particular session, we'll focus only on Python. And let's talk about, there are some algo trading platform which are available in the market, which give you the access to perform and build the algo by yourself without much of infrastructure required. Mean they give the connection to the broker by themselves. They give the backtesting platform to you, so it is little easier for you to do the backtesting and perform and build the algo by yourself. So one of them, which is very popular, is Quantopian. You can build your own algos using Python. You can write the Python algos there, and the backtesting results will be visible in front of you. But it is very more specific to US market. Next is Quantra Blueshift, which there also you can write the Python algos. It is based on the library called Zipline, and this is almost very similar to Quantopian, and it is more specific to Indian market than other markets. And there is one more tool which is QuantInsti. There also you can write Python algos. And the fourth one, which is very popular in India, is Zerodha Trade. This is an algo trading platform where you don't need to know the programming. You don't need to have the skills of programming languages. It gives some UI interface. On the basis of that, you can build some algo, but it has some limitations. It can't go beyond that. Generally, it makes use of some indicators, but something like if you have to perform arbitrage, or you have to check correlation, co-integration, whether it will work or not, pair trading, it is not good for that. So if you want to perform pair trading and arbitrage, it's better you go for Python related platforms. And there are some Python libraries, I would say, which are very popular, which we can discuss of. If you talk about data processing, then data pre-processing, URLib, Pandas, NumPy, Scrappy, and Beautiful Soup are very popular. Out of that, URLib, Scrappy, and Beautiful Soup are for web scraping libraries, and Pandas and NumPy are for data, for calculation of the data and other pre-processing activities. And let's talk about the backtesting libraries. There are few backtesting libraries are very popular. Among them are TLib, that is technical analysis library. So it is good for checking the candlestick patterns and the all other most of technical indicators take care of. And Backtrader and BT are also very popular. It takes care of the backtesting results as well as the technical analysis. There is one more very important library in Python, which is Mebian-lib. Mebian-lib is nothing but for calculation of option pricing. This is very useful. And if we talk about sentiment analysis, then Stream Python is there. Feed parser is for generally being used for uh, getting the feed of the news. TweePy is for Twitter sentiment analysis. TextFlow and NLP is again for sentiment analysis. So let's move again to the trading concept where we left, and let's start from there. So we have already completed and seen that how we can do the brainstorming of the idea, and how we can come to the and conceptualize the new idea. just looking at the data, how we can come and conclude some new idea. So now we will take one particular example and we'll walk through with that example till the end. And till the end means we'll build one idea. We will visualize the model of it. After that, we'll do the backtesting of it and we will build a Python script and see how it works. So we'll take the example of again the agriculture commodities. So as we know, agriculture commodities are relatively less volatile in nature as compared to the other instruments like equities and forex. So they revolve around the same price range. This is one hypothesis we are going to take. So considering this, so what we have to do, we need to find out what will be the logic behind our idea. The logic on the basis of this will be because they are less volatile in nature and they will revolve around the same price range. We can apply mean reversion trading strategy on that. So there is an indicator called Bollinger Band. There it is very good for applying mean reversion strategies. It takes care of the standard deviation and the mean reversion in this, and the it has the attributes of standard deviation and mean in this, which on the basis of that we can decide some levels. So the logic which we will keeping is if the close price will go below -2 standard deviation below from the mean, then we will go for the buy, and as soon as it will go +2 standard deviation above the mean, we will sell. And what will be the frequency of the trades? Let's keep it daily frequency, and the segments, as we agreed, that will go for the agri commodities, and the backtesting period we'll keep it at least 1 year, and it's better we keep it for more period if we get the data. And automation tool, as we have decided that in this session we'll use Python for algo trading. Now next stage would be, now we have decided that what is the trading idea and what is the logic which we are going to use. So let's discuss what is the next stage, that is the filtering criteria. So we have already decided the segment, on which particular segment, that is agricultural commodities, which we are going to be used. And now we have to decide on which commodity or which instrument we will be using to apply that logic. So we have to find out the script where this particular logic will be best fit for the this particular logic, that we need to find out. So we need to see that this script has to be very liquid. So for the liquidity, we will be seeing that volume of the commodity should be at least more than 1000 in a day. Then only we'll filter out that script. So based on these criteria, we have decided that we can go for a commodity called chana. Chana is one of the agriculture commodity which is tradable in NCDEX. So we'll go to trade for that. So as we discussed that first way of verification of the trading idea would be visualizing the model. So we can do the visualizing the model through different ways, but in this particular example, we are using investing.com. We have just draw the same indicator with that commodity chana. So it looks like there are various levels you will be able to see. There is lower level is there, upper level is there, and mean is there across the price, which is candlestick pattern. If we see it closely, then the lower level is -2 below the standard deviation, and the upper level is +2 above the standard deviation above the mean. So if we see the candlesticks are touching most of the time both the levels, and it is coming back to the mean after touching the above and below level. So by looking at this, it seems like the logic which we have decided, that trading between -2 standard deviation and +2 should work. So on this basis, we will move to the next stage, that would be backtesting of the model. In backtesting of the model, we will be doing the verification of the logic using historical data. We will be doing the detailed analysis. Why we have to do? We have to do this to save our time, effort, and money. If we do it without backtesting, we will deploy it directly in the live environment. We can lose the money, so it is very important. And we need to use various backtesting tools which we have discussed before. The prerequisite is to have the historical data in place and the formulation of the logic. And once we are fine with that, we'll move to the paper or simulation trading. There are various parameters which are required to be considered in this backtesting stage. That is like returns, maximum drawdown, maximum continuous drawdown, maximum profit, maximum continuous profit, and so on. You will be able to see this in the screen. And these are, again, this is not so comprehensive list. It can be changed depending upon your requirement, that which particular parameter is more important for you. And there are some more parameters which are required to be, we need to think of and consider. That is stop loss or trailing stop loss. In how much stop loss has to be there, or whether we should use stop loss or we should use the trailing stop loss. And what should be the target price or percentage? What should be the entry criteria and exit criteria? These are the foremost point we need to consider while doing the backtesting. So in this, we will be performing various activities. I will listed down these activities. First thing is we need to download the data from some open portal where we can which allows us to download the data. So we will prefer to download from investing.com into CSV file. Once we do that, we will import the necessary libraries. After that, we will fetch the data of that instrument from that CSV file. We will write some supporting functions to achieve our logic. After that, we'll write another function to generate buy and sell signals. After that, we will visualize the output, how it looks like. And after that, we'll see that how much return or strategy is generating. So I will do one thing. I will open the algorithm which I have already written down in the interest of the time. So as you can see, there are few libraries we have imported, like pandas, numpy, datetime. These are the pandas, date, and numpy are for calculation and storage of the data in memory during runtime. Seaborn, matplotlib, and plotly. These libraries are for visualization purpose. So I will just explain the functions which I have written down here. So I'm not using any backtesting library which are there in the GitHub. I wrote some of my own functions here for backtesting, which we will be using in this particular algo. So this particular function is to backtest any strategy by using these parameters. So this functions This function takes few parameters like data frames, strategy type, long or short, entry criteria, exit criteria, positional feed, and on the basis of all these parameters, it returns the buy and sell signals of the data. So like the first data frame is nothing actually but the raw data like open, high, low, close price. This will have, and the strategy type like long or short, whether we want to go only long, it is only long strategy or short strategy that we have to mention. What will be the entry or exit criteria? What will be the price field? Like sometimes generally people use close price, but in this function we can even use open price also. So we can specify which particular field will be there to consider the calculation of the or buying or selling the price. What will be the stop loss percentage? What is the target percentage? All these things will be is possible to be configured here. And there is one more important thing. Few traders, if they are taking the positional trade, they want to take only profit, even if they want to, even if they have to hold the position for some time. So for this, the parameter I kept is only profit. Mean till the time the trade will not go in the profit, it will not exit from there. So this is that kind of profit. If we keep it as true, otherwise if we keep this parameter as false, then as soon as the exit criteria will meet or the stop loss will meet, it will come out. So we'll come back to this function later. So this is what the purpose of this function. The next function will be, once we complete the backtesting, we need to see some reports, how it looks like, the graphical reports and the statistics part of it. So that I have kept wrote in the function called backtesting report local. So it takes a DF summary. DF summary is nothing but the trading trades which were taken by the during the backtesting results. How much is the lot size? How much is the transaction charges? And this function is fetch data. So here we will be defining that how we have to fetch the data, which we have downloaded from investing.com, that CSV file. So that I have written it here. Next function is, like we have decided that we'll go with the indicator called Bollinger Band. So I've defined this function as BB, that is Bollinger Band. So this particular function will make the levels like mean, upper level and lower level using the standard deviation and mean. So like if you see DF temp, price field and strategy type is there. On the basis of that, it will make the levels. So we have to define here is the rollback period, how much rollback period we need to see. On the basis of that, mean and standard deviation as will be defined. So like we have decided that we'll go for 2 and -2. Let's keep the same figure here. So standard deviation below 2 and standard deviation above 2 we will be using. This function is for drawing the candlestick chart. And this is the main function. If you see, we are passing which script we need to do the backtesting, how much is the lot size, how much is the transaction charges and slippages. So here we are invoking for entry and exit criteria, we are invoking the function called BB, which we just defined. So which will create the levels, upper and lower levels. And in the same function, we are invoking the function called backtest strategy stop loss, which will give us the buy and sell signals. And once that is decided, then this main function will return the summary mean summary of all the trades. which we will be using to generate the trading backtesting reports. See here. So we will currently, as we have decided the lot size as 1, transaction charges as 0 for simplicity. We can even divide the slippages. Generally, we should decide the slippages based on the bid and ask between between the instrument which you are planning to trade. So as of now, I kept it again 0 for the simplicity. So like we said, like we have seen, we are using BB backtest positional script. If we run, then it will return the data frame with all the trades there, and after that it will generate the backtesting report, and on the basis of that we can see, we will generate one graph where we will be able to see what are the signals were performed, were generated, and at what point of time. So I will do one thing, I will run all of them one by one. So I didn't run the whole script as of now, so that I can show you what is happening. So till here we have declared all the functions and we have imported all the libraries. Now we have declared the input variables also. Now in this, it is invoking the backtesting function. Now if you see, I will show you how summary min looks like. So these are the trades which it has created. So if you see, it has, this is buy at this price, this is the buy time, sell time, buy price, sell time, these are the returns, these are the cumulative returns, investment period, and these are the what kind of strategy it pursues, long or short. This is also mentioned here. So we got the transaction summary now. If you run the next report, it will show us the statistics as well as the graphical representation of the output with what we have just generated. If you see, it is saying sum of returns in percentages 20.33%, average return per transaction is 2.9%. So it is showing the statistics of what we wanted to show, what we want to see. It has also generated the graph, the returns graph over a period of time. And this is one analysis report. On the basis of that, we can decide how much stop loss or target we need to keep. Like if we see, look into this closely, then percentage returns, this graph is for percentage returns versus count of transaction. So it means this, we got the -3% return one time, -2% return two times, 4% return one time, like this we can see. So it means if we keep the stop loss around -1.5, then we may not incur this -2% loss and -3% loss. And the maximum profit which we are getting is 8%. So we don't need to go, we can keep the target as 8% or 9% maximum. Like this we can do. As of now, see, we kept the stop loss as -2 and target is 10%. So we can maybe change it to 9 or 8.5 and 1.5. So it is still showing the loss is -3%, -2% 3 times, and -3% 1 time. Maybe because there may be, we are doing this on daily basis, on daily frequency. On it is possible on some particular day where the signal come, on that particular day the loss, it was the commodity might be in the opposite trend, to the extent to -2 to -3%. So this is beyond our control. And here it is showing how it looks like. So the red line is actually the close price, and green line is actually the lower level. Orange line is actually the upper level. If we see, and this blue bars, the vertical bars, vertical lines are nothing but the signals. So we can see which trade was taken. On the basis of looking at this graph also, we can maybe modify or optimize our parameters. Like if we see, this buy signal was taken here, sell signal might, this buy signal was taken here, sell signal might have taken little after some time. So maybe we can change our parameters accordingly if we use little longer period of time. Let us say if I use 1.5, 1.6 and 2.2, how it looks like. So if you see, the returns went down. So this is not the good configuration. So we understood that how to write the algo, but we don't know how to optimize the algo. So there is one way of doing this, that whatever parameter which we want to optimize, we can make one more algorithm which will invoke this algorithm which we just wrote, and it will run the same algorithm multiple times using multiple parameters, set of parameters. So how to do that? Let's look into that. So this is another algorithm. It is almost similar to what we have seen before. If you see, same set of functions are there: backtest, strategy, stop loss, backtest, report, local, fetch data. This is almost same algo which we have just wrote. The only difference is, now what are the parameters which we want to optimize? We want to optimize the look back period, that is rolling back period. So as of now, we had taken 20 days of rolling back period, but we don't know whether 20 is the best period or not to look back the data or not. So we have taken various figures like 12, 17, 20, 22, 23. This is a list of various values which we have taken, which we think that it could be, one of them could be the best value. And instead of taking the lower standard deviation as -2 and upper as +2, so here we have taken the list of various values again ranging from 1.2 to 3. Similarly for up also 1.2 to 3. So using that, we have made the combination of all those parameters which will be here in this list. I will show you how it looks like. So this combination function will actually make the three pairs of all these variables into and make one comprehensive list. So this is how the function it looks like. It's making a loop of list A, B, C. These are the three lists which we are going to be used. So list all has combination of all these three. list which we want to make use of. Let us see how it looks like. So it made it, see, it has made around 1,000 pairs. So these are the various lists. And what are we doing after that? So we are using each of these pairs, running the algo which we have just developed one by one using these parameters, and we are checking what is the backtesting result in that, and we are storing the results in one data frame called df optimizer. Once everything is stored there, we are checking in which particular row it is returning the maximum returns. That particular, we are taking the data of that particular combination. We are storing the variable into optimized rollback period, optimized lower level, optimized upper level, and after that we are running the function again. So this is what we are doing. Let's see how it looks like. So if you see, it is running all the combination one by one, and it is displaying the results also in front of us. It will take a while to complete. Till the time it completes, let's go back to the presentation and see what are the things we need to see it after that. So like we have covered the backtesting results, these are the outputs. So output we have already seen on the in the editor, Python editor. Next one was optimization. In optimization, again, it depends upon the backtesting results. There are various ways of doing the optimization of the parameters. So backtesting is one way of doing that. There's some optimization algorithms are also available in machine learning and deep learning. I'm not emphasizing on that as of now because not everyone has the background of machine learning and deep learning. So we'll focus with the simple approach that is based based on the backtesting data. We will be coming up with the optimization parameter. So that's what we are running as of now. But in this, we have to make sure the very important thing is we need to see we should not do the overfitting of the data. I mean, overfitting is nothing but if we take only the best parameter with the best returns, then it may work in the backtesting, but it may not work in the real scenario. Because in real scenario may not be always same as the backtesting period. So we need to be very concerned about that. So whatever period we are running, we took the backtesting and we are coming out with the optimization parameter. We need to run the same parameters with some next period also. So and we need to see whether it is generating the similar kind of result or not. Then we will be little more sure that optimization parameter is correct. So let's go back to the editor and see where we. So yeah, it's already completed. So let me download the report and see how it looks like. So this is all the code which we ran. So if we see it is showing the output of each set of parameters. This is the rollback period. This is lower level. This is upper level. This is the returns, mean of the returns, maximum drawdown, win-loss ratio. So it ran for all 1000 combination. After that, it has shown it to us that these are the returns, maximum return, which it got from out of all these combinations, that is 22.8. If you remember in the previous combination which we ran, it was around 9% of returns. But now the more with the optimized uh, parameters, we are getting the returns as 22.8, and the best rolling back period is 22. Best optimized lower level is 1.6, and optimized upper level is 2.2. And this it is showing the statistics of the same. This is the return graph, and these are the signals. So let's go back to the PPT again. So once we are done with the optimization of the parameter and we are find that it is working fine, so we need to do the paper trading. Paper trading, again, as we already know, that it is as good as performing the trade in the real market. The only thing is we are not performing the we are not investing the money into it. Without investment of money, we are performing the trade. The only drawback in this is very time consuming activity. This is very time consuming activity. And the good part about this, it is we don't need to invest money into it. Without investing the money, we'll get to know that how it is going, how the algo will be performing in the real market. Once we are satisfied with the paper trading, we need to go live. So there are various aspects which are required to be which we need to think about in go live stage, and which we have not discussed and which we have not think of in backtesting and paper trading. That is order management, risk management, money and fund management. So in paper trading, we were checking whether the algo will perform good or not, but we were not investing money, we were not managing the assets. So here the diversification of the asset is also very important. Portfolio management, user management, slippages doesn't come in paper trading and back testing easily. So, and another thing, if we talk about technically, then technically we need to establish a connection with the broker. We need to pass buy and sell orders. So again, these things were not there in previous stages. So these are the specific steps we need to, and activities which you need to take care in the go live activity. So to summarize whatever we have discussed so far, I would say that this is all these activities are very similar to software product development life cycle. So algo is nothing but the software and software product. So most of the activities which we have just discussed can be easily mapped to software development life cycle. We will just look into that once. Like we can say formulating the trading strategy or idea and filtering the criteria to find out the script can be easily mapped with the planning and requirement and design stage of the software development lifecycle. And implementation part can be mapped with the verification of the logic and optimization of the parameter and backtesting. Quality assurance can be easily mapped with the paper trading and simulation trading. And production deployment can be mapped with the deployment of the algo in the real environment. So I would say all these stages are very important in their own. So nothing can be ignored. Even one can be missed, or we don't take care of it properly. The whole project can go for the toss. So everything is important. So this is all about the session now.
Thank you so much, guys. It's a pleasure hosting you all. Thank you. Thank you, Sunil. Thank you, everyone. Bye bye.
Thank you.